क्या आप इन्वेस्टिंग करना चाहते हैं बट पता नहीं कहां से शुरू करें? This is the only video you'll need. This complete guide will show you how to get rich using the stock market, and don't worry, I'll keep it simple and fun. No complicated math or charts. आप ये वीडियो देखो या ना देखो, but let me take 30 seconds to tell you something important. Investing सिर्फ एक स्किल नहीं है, ये एक फंडामेंटल लाइफ स्किल है जो हर किसी को सीखनी चाहिए, चाहे आप टीचर हो, बिजनेस ओनर हो, स्टूडेंट हो या कोई भी प्रोफेशन में हो। वेल्थ ग्रो करना सीखना बहुत ज़रूरी है ताकि आप अपने और अपने फैमिली का फ्यूचर सिक्योर कर सकें। I've been investing in stocks for 22 years और बहुत कुछ सीखा है, और मैं नहीं चाहता कि आप वही मिस्टेक्स करें जो मैंने की। इसलिए I'll share my best ideas and learnings with you today. This guide is perfect for everyone, whether you're completely new to stocks or already have some experience. मैंने इसे simple, easy to follow sections में divide किया है. We have links in the description below, using which you can skip to a section that interests you the most. But मेरी advice है कि पहली बार आप पूरा वीडियो एक बार देख लें। हर section एक puzzle piece की तरह fit होता है, helping you become better at investing. So, are you ready to take control of your financial future and create wealth? Then let's begin. Interestingly, a few days back, I was hanging with an old friend from school, और मैं उसको इन्वेस्टिंग के बारे में कुछ बता रहा था, और तभी वो एक छोटा थम्स अप पी रहा था। मैंने उससे पूछा कि थम्स अप का प्राइस क्या है, and he said, I think it's 20 rupees. Then I asked him कि do you remember school के टाइम में about 20 years ago, what was the price of it? He said $5, and I think that was a fair guess. तो obvious बात है कि प्राइस काफ़ी इंक्रीज हुआ है, राइट? बट एक दूसरा एंगल भी है। एक्चुअली एक छोटा थम्स अप की वैल्यू सेम ही है। A छोटा thumbs up is still worth that same छोटा thumbs up, लेकिन तुम्हारे पैसे की वैल्यू अब क्वार्टर रह गई है compared to 20 years ago. वही 5 रुपए में आज आप सिर्फ एक क्वार्टर बॉटल या 50 ml थम्स अप खरीद पा रहे हो। Simply put, रुपये की वैल्यू कम हो गई है। इस फिनोमिनन को जहां प्राइसेस कंटिन्यूसली राइज होते हैं, we call इन्फ्लेशन। एंड जैसे जैसे इन्फ्लेशन से प्राइसेस बढ़ते हैं, वैसे वैसे तुम्हारे पैसे की वैल्यू डिक्रीज होती है। देन ही आस्क्ड मी, कि मेजर कैसे करते हैं इन्फ्लेशन को। इंडिया में इन्फ्लेशन लास्ट ईयर कुछ 6% था। देयर आर टू इंडेक्सेस व्हिच ट्रैक देम, which is the wholesale price index and the consumer price index, WPI और CPI बोलते हैं इसको। बेसिकली इसका मतलब क्या है कि एवरेज में हर चीज अब 6% मोर एक्सपेंसिव है कंपेयर टू लास्ट ईयर। एंड अगर तुम्हारे पास सेविंग्स है तो बेसिकली इन्फ्लेशन आपको धीरे धीरे गरीब बना रहा है। मैंने उसे एक इन्फ्लेशन का चार्ट दिखाया, राइट? आई शो इट टू यू आल्सो, राइट? दिस इज अ चार्ट। और उसको मैंने एक्सप्लेन किया कि उसके पास अगर आज 5 लाख रुपए है तो 10-11 साल में अगर वो कुछ भी नहीं किया तो उसके 5 लाख की वैल्यू विल रिड्यूस टू 2.5 लाख, 2.5 लाख हो जाएगा, यानी कि आधा। माय फ्रेंड गॉट वरिड और बोला कि ये इन्फ्लेशन तो बहुत डेंजरस है, इट्स एक्चुअली लाइक चूहे आर स्लोली ईटिंग योर मनी। ट्रूथ ये है कि स्टॉक मार्केट दुनिया का सबसे पावरफुल वेल्थ क्रिएशन मशीन है। Let me say that again. स्टॉक मार्केट दुनिया का सबसे पावरफुल वेल्थ क्रिएशन मशीन है। स्टॉक मार्केट ने मिलियंस ऑफ ऑर्डिनरी लोगों को वेल्थ क्रिएट करने में हेल्प की है और उनके फाइनेंशियल गोल्स अचीव करने में मदद की है। Let me share some data, right? Now this is over 20 years. See on this graph, लास्ट 20 साल से हम 4-5 चीज़ों को कंपेयर करेंगे। इंडियन इक्विटी, यूएस इक्विटी, गोल्ड, रियल एस्टेट और डेट। डेट यानी फिक्स्ड डिपॉजिट्स यू कैन कंपेयर कि डेट इज़ व्हेन यू डायरेक्टली गिव loans to the companies themselves, right? आप देख सकते हैं कि over 20 years we have the Indian equity has outperformed बाकी सब markets. आपको 16.1% compounded annual return मिला है equity से, compared to 13.9 in US, 12.8 in gold, 8% in real estate and 7% in debt, right? अगर आप ये देखें कि आपका पैसा कितनी गुना मल्टीप्लाई हुआ है, right? Over 20 years in equity, your money has multiplied 20 times. Compare that with real estate or debt जहाँ पे 4 या 5 times हुआ है, or gold for that matter, which is 11 times, right? There is no question that the stock market has outperformed all other asset classes by a long way. So, जो हमने returns देखे, right? On stocks we have 16%, on bonds we have 7%. I want to actually show you कि एक आदमी के lifetime में how much of a difference this makes when it comes to creating wealth, right? Let's assume कि एक normal working person का working lifetime होता है about 35 years and they're able to save some money. Let's assume कि 10,000 rupees आपने हर महीने save किया, you know. So taking that as our base, let's just feed some numbers into our sheet and see what it looks like. Let's assume 10,000 rupees a month is what you're saving, which means in a year you'll end up saving 1,20,000 rupees, right? So let's say the yearly contribution you started in 1990 and खत्म हुआ 2025, मतलब अभी जो नया साल हुआ है 2025 is your last and you're contributing 10,000 rupees a month. So you've actually contributed for 35 years and so दोनों cases में वही same data है except the annual return is what changes. मैंने stocks में 16% use किया है and let's use 7.5% for debt, right? So let's calculate this and see what it looks like. So at the end of 35 years, you're investing the same amount of money in two different assets. In stocks, आपका return हो गया 15.61 crores. Compare that with bonds, आपको 2 crore rupees मिले. मतलब the same amount of money at different rates of interest, आपको stocks give almost 8x returns compared to bonds. That is the power of compounding in the stock market, right? It has outperformed all other asset classes by a long way, right? Now that we've seen that stocks outperform all other asset classes, there's another very common question that I keep hearing from the market. पैसा कितने दिन में डबल होगा, right? 25 दिन में तो डबल होना थोड़ा मुश्किल है, but I can tell you about a simple shortcut, mathematical shortcut, which is called the rule of 72, right? Now, rule of 72 से आपको पता चलता है कि पैसा डबल होने में कितना टाइम लगेगा. Let's say आपके पास 10,000 rupees है बैंक में और हर साल आपको 10% yearly interest मिल रहा है, right? I'll just quickly put it in a sheet so we can see how that moves, right? एक साल बाद आपके पास कितना पैसा होगा? First year you have 10,000 rupees, interest is 10%. At the end of year 1, you have 11,000 rupees. और 2 साल बाद, when I add the information to the second year, you have 12,000? No, it's 12,100 because अभी 11 आपका capital 11,000 हो गया. 11,000 का 10% हो गया 1,100 रुपए, which makes it 12,100. Similarly, as I just keep adding on year after year, I can see कि after year 7, it's become almost, at year 7, it's become 19,487 rupees, which is almost double, right? तो approximately आपको 7 से 7 साल के से थोड़ा ज़्यादा लगा. Now the simple rule is that आपका जो भी interest rate है, right? जो भी आपका जो return है या interest rate जो भी है, उसको आप you divide 72 by that number. So in our case, the number we have is 10%, right? If I divide 72 by 10, I get 7.2. 7.2 is the approximate amount of time it takes to double my capital if I'm investing at 10%. अगर मैं 20% पे इन्वेस्ट करूँ तो कितना टाइम लगेगा for doubling? It's 72 divided by 20, which gives you about 3.6 years, right? So this is a very simple mathematical जो आप एकदम without any sheet आप कर सकते हो just to figure out कि ये rate of interest पे आपको कितना टाइम लगेगा to double your money. I want to tell you an interesting story, right? जब वॉरेन बफेट टीनेजर थे तो that time उन्होंने compounding शुरू की थी. And you know, when he was 18 years old, he started investing, I think about $10,000, and he was earning about 24% per annum. तो पता है कितना साल लगा था उनको पैसे डबल करने में? 72 divided by 24, 3 years, right? Every 3 years he was able to double his money. And उनका एज पता है कितना है अभी? He's about 95 years old. So which means 95 minus 18, 77. 78 divided by 3 is about 26. So he's actually multiplied his money 26 times, he's doubled it over a lifetime. और अगर आप $10,000 से शुरू करते तो you end up at $640 billion. So that's the power of compounding over a lifetime, and that's how Warren Buffett has been able to create such immense wealth in the markets. Now that we've learned that stocks is the road to creating wealth, let's dig a little bit deeper into it, right? स्टॉक मार्केट को एक ब्रिज की तरह समझो. एक साइड पे हम जैसे रेगुलर लोग हैं विद सम सेविंग्स, और दूसरी साइड पे बड़े कंपनीज हैं हु नीड मनी टू ग्रो देयर बिजनेस. स्टॉक मार्केट इन दोनों को कनेक्ट करता है. अब कूल पार्ट ये है कि व्हेन यू इन्वेस्ट इन द स्टॉक मार्केट, योर मनी डजंट जस्ट सिट देयर. इट हेल्प्स कंपनीज ग्रो बिगर, एंड व्हेन कंपनीज ग्रो, something amazing happens. They create more jobs, people earn more money, and these people then save that money, and then they can invest again. This is like a big circle of growth, right? लेकिन अगर हम सब अपना पैसा घर पे रखेंगे तो कुछ ग्रो नहीं होगा, ना कंपनीज, ना जॉब्स, ना सेविंग्स. इसलिए स्टॉक मार्केट इतना इंपॉर्टेंट है इकोनॉमी के लिए. अब मैं जानता हूं आप क्या सोच रहे हो. इज इट सेफ टू इन्वेस्ट? यहां पे सेबी की एंट्री होती है. दैट्स वेयर सेबी कम्स इन. थिंक ऑफ सेबी एज द रेफरी ऑफ द स्टॉक मार्केट. दे मेक श्योर एवरीवन फॉलोज द रूल्स, नो वन चीट्स, एंड योर इन्वेस्टमेंट्स आर प्रोटेक्टेड. एक मिथ है कि मार्केट्स आर लाइक गैम्बलिंग. याद रखिए, स्टॉक मार्केट बिल्कुल भी गैम्बलिंग की तरह नहीं है. इट्स अ वेल ऑर्गेनाइज्ड सिस्टम जहां रेगुलर लोग और कंपनीज एक दूसरे को ग्रो करने में हेल्प करते हैं. जब आप वाइजली इन्वेस्ट करते हो, आपका मनी आपके लिए काम करता है और आप एक स्ट्रॉन्ग इकोनॉमी बिल्ड करने में भी हेल्प करते हो. सो नेक्स्ट टाइम कोई आपसे स्टॉक मार्केट के बारे में पूछे, आप उन्हें बता सकते हो, ये सिर्फ स्टॉक्स खरीदने और बेचने का सिस्टम नहीं है. इट्स अबाउट बीइंग पार्ट ऑफ समथिंग बिगर जो सबके साथ में ग्रो करने में हेल्प करता है. And don't feel intimidated. Basics इतने complicated नहीं है. अगर आप 5th grade math समझ सकते हो तो stock market भी समझ जाओगे. So let's start with the simplest unit, right? So the simplest question is, what is a share or a stock? You know, sometimes चीजें इतनी expensive होती हैं कि हम afford ही नहीं कर सकते. एक बड़ी कंपनी के बारे में सोचो. इट्स लाइक अ मैसिव पीस ऑफ लैंड जो इतना एक्सपेंसिव है कि कोई एक पर्सन अकेले अफोर्ड नहीं कर सकता. कंपनी अपने आप को छोटे पीसेस में डिवाइड कर देती है जिन्हें शेयर्स कहते हैं. सो इट्स लाइक जस्ट कटिंग अ बिग केक इनटू स्मॉलर स्लाइसेस, राइट? हर स्लाइस या शेयर कंपनी का एक स्मॉल पार्ट होता है जो लोग अफोर्ड कर सकते हैं. लेट मी मेक इट इवन सिंपलर, राइट? इमेजिन एक कंपनी को 100 पीसेस में डिवाइड किया गया है. अगर आप एक पीस या एक शेयर खरीद लेते हो तो आप कंपनी के 1% के ओनर बन जाते हो. बट रियल कंपनीज में यूजुअली बहुत ज़्यादा शेयर्स होते हैं, समटाइम्स लैक्स और इवन करोर्स. So अगर किसी कंपनी के 1 करोड़ शेयर्स हैं तो ईच शेयर कंपनी का एक टाइनी फ्रैक्शन होता है. एंड यू नो द बेस्ट पार्ट, कोई भी इन शेयर्स को खरीद सकता है. यू कुड ओन जस्ट वन शेयर, या फिर आपके पास बहुत ज़्यादा पैसे हैं तो हंड्रेड्स या इवन थाउजेंड्स ऑफ शेयर खरीद सकते हैं. लेट मी शो यू अ क्विक एग्जांपल कि लोग डिफरेंट अमाउंट्स ऑफ शेयर्स कैसे खरीदते हैं. राइट, लेट्स इमेजिन दिस स्क्वायर ऑफ 100 ओनली अगेन. सो इट्स पर्सन ए काफ़ी शेयर्स ओन करते हैं. से ही ओन्स 2% ऑफ द कंपनी. राइट, यू कैन मार्क दैट. Let's say a person has a lot more money and he buys 5% of the company, right? And let's say person C decides to buy 1% of the company. So even owners का share इसी में होता है. Technical term for owners is promoters. और जो बड़े investors हैं, जैसे बड़े investors normally होते हैं कि mutual funds हो गए या insurance companies या foreign investors, ये लोग भी इसी में पार्टिसिपेट करते हैं. एंड दे यूजुअली बाय लार्ज अमाउंट्स ऑफ शेयर्स. सो प्रोमोटर्स यूजुअली हैव लाइक 50% और इवन मोर, एंड these big institutions tend to buy like 5, 10, 15, 20% depending on the size of the company. So now let's understand how stocks and company ownership work through a simple example. Let's say there are 3 friends, Alok, Divya and Rahul, who make amazing ice cream. They decide to start a business called Best Ice Cream. Let's call it BIC for short. So they need to pool in their money to get started, right? So they register a company. A company is nothing but a legal entity separate from its owners. So as shareholders, the owners have a claim on the portion of the company's assets, that is what it owns, and its profits, but they're not personally liable for the company's debts or actions. So the company raises this money by selling stock, which is also called equity or shares. A stock represents a partial ownership of a company, right? So the owners of the stock are called stockholders or shareholders. So the stock becomes nothing but a financial security that represents ownership of a fraction of the company. So in this case, let's say the total investment they need to start this business is 10 lakhs of rupees. So based on their investments, how much of BIC should each person own? So now let's say Alok, Divya and Rahul decide to turn BIC into a company, right? So they decide to sell stock of their new business for rupees 100 per share. Now it's easy for us to figure out how much of the company they will own as stocks. It's very simple. Let's just take the total amount, that is 10 lakhs of rupees. And now let's assume that Alok has invested 6 lakhs of rupees, Divya 3 lakhs and Rahul 1 lakh. So based on this, we can just calculate, just take the number of shares you own and divide it by the total number of shares the company has issued. So the total number of shares in our case is 10 lakhs divided by 100, which gives us 10,000 shares. So based on Alok, Divya and Rahul's investments, they own 6,000, 3,000 and 1,000 shares each. So now that brings us to the question, why do stocks have value? So let's continue with the same example. Let's say now BIC Ice Cream makes 5 lakh rupees in profit during its first year, right? So Alok, Divya and Rahul, since their first year of profits, they're very excited. They decide to take that entire 5 lakhs of rupees in profit and pay it to themselves. In business terms, this is called paying a dividend, right? A dividend is when a company gives some of its profits, which are called earnings or net income, back to its shareholders. And here's how the dividend calculation works, right? Dividend per share is total dividend amount, which in our case is 5 lakh of rupees, divided by the total number of shares, that is 10,000 shares. So that gives us 50 rupees per share. So you, as when you're listening to this story, would you like to own shares of BIC? You should, right? It seems like a successful business that has paid each of its investors rupees 50 for every share of stock that they own in just 1 year. That can be very valuable to you as a shareholder. Now, I'm imagining, what if BIC makes 5 lakhs of profit in the next year? Or what if it makes 10 lakhs of profits? You might be willing to pay Alok, Divya or Rahul to buy some of their stock, right? If your answer to any of those questions is yes, then the stock has value. And that is why stocks have value. When you own a stock, you have a legal claim on a portion of the company's future profits. If that business makes money, then that money belongs to the shareholders. Importantly, profits are not always paid out to shareholders in the form of dividends. Often, a company's management team will keep its profits inside the business and use them to buy equipment or pay off debt, hire employees, or for some other business uses. However, no matter what the company does with its profits, the profits always belong to the shareholders. And that is why stocks have value. So, what is the stock market? Let's take a scenario. आलोक को पैसे की जरूरत है और वो अपने बेस्ट आइसक्रीम के शेयर्स बेचना चाहता है, बट दिव्या और राहुल उससे शेयर्स खरीदना नहीं चाहते. अब आलोक को कोई और इन्वेस्टर ढूंढना पड़ेगा जो उसके शेयर्स खरीदने के लिए इंटरेस्टेड हो. और ये कैसे होगा? दिस हैज बीन एन एज ओल्ड प्रॉब्लम. 1792 में एक ग्रुप ऑफ इन्वेस्टर्स फ्रॉम न्यूयॉर्क सिटी गॉट टुगेदर एंड सॉल्व दिस प्रॉब्लम. This group gathered on a road called Wall Street to buy and sell or exchange shares in businesses with each other. 1875 में मुंबई में भी कुछ इन्वेस्टर्स ने एक बैनियन ट्री के नीचे सिमिलर प्रॉब्लम सॉल्व करने के लिए मिले थे. जैसा कि हमने देखा, स्टॉक मार्केट बेसिकली एक ऐसा प्लेस है जहां बिजनेसेस और इन्वेस्टर्स एक दूसरे से कनेक्ट करके स्टॉक्स बाय एंड सेल कर सकते हैं. सिंपल वर्ड्स में समझे तो ये एक वेजिटेबल मार्केट की तरह ही है, बट यहाँ वेजिटेबल्स की जगह आप बिजनेसेस के शेयर्स ट्रेड करते हो. मुंबई की ये इन्वेस्टर्स ग्रुप टाइम के साथ ग्रो करता गया. आज भी ये एग्जिस्ट करता है. इसे बॉम्बे स्टॉक एक्सचेंज कहते हैं, जो एशिया का ओल्डेस्ट स्टॉक एक्सचेंज है. A stock market is a place where businesses and investors connect with each other to buy and sell and issue shares of publicly held companies. आज इंडिया में दो मेजर स्टॉक एक्सचेंजेस हैं. एक है BSE जो बॉम्बे स्टॉक एक्सचेंज, और दूसरा NSE जिसे नेशनल स्टॉक एक्सचेंज कहते हैं. ग्लोबल लेवल पे भी मेजर एक्सचेंजेस हैं जैसे न्यूयॉर्क, हांगकांग, शंघाई, लंदन. ऑल ऑफ दीज हैव बिग स्टॉक एक्सचेंजेस, राइट? अब when it comes to the market, you know these numbers you sometimes see flashing on your TV or your phone's financial app? Sensex up 500 points, Nifty hits all-time high. Ever wondered what these actually mean? In India mein we have two main stock market indices, Sensex and Nifty. Let me break it down for you. Sensex tracks India's 30 largest companies and it tracks them on the Bombay Stock Exchange. And Nifty tracks 50 major companies and their prices on the National Stock Exchange. इन इंडाइसेस को स्टॉक मार्केट का रिपोर्ट कार्ड समझ लीजिए. जस्ट लाइक आपके क्लास का एवरेज बताता है कि क्लास ओवरऑल कैसे परफॉर्म कर रही है, ये इंडाइसेस बताते हैं कि ओवरऑल मार्केट कैसे परफॉर्म कर रहा है. दे ओनली ट्रैक द कंपनीज प्राइसेस, व्हिच मीन्स दैट $100 शेयर has more weightage or 10 times more weightage than a $10 share, irrespective of what the company's actual sizes are. This price weighting approach worked for some time, but in a real market scenario where there are so many companies with different share prices, this started causing issues. So our indices in India are weighted by market capitalization. Do you remember what is market cap, or have you forgotten? Price times number of shares. इससे कंपनी के करंट साइज के अकॉर्डिंग इंडेक्स बनती है, which gives a much better picture taking the biggest companies in the country. You know, there's an interesting fact. Dow जब शुरू हुआ था 1896 में, do you know what the average price was? It was around 40. और आज पता है डाउ कितने पे चल रहा है? 44,000 points पे. That's the power of compounding again. So why do companies go public? Let's return to our best Indian coffee example. So our founders, Alok, Divya and Rahul, believe they can grow big profits by opening new locations, right? So they plan to build 10 new stores. They find out that the cost of each is about 8 lakh of rupees. So उनका total requirement हो गया 80 lakhs. So how are they going to get this 80 lakhs of rupees? The first option is to go to the bank and say, borrow the money. However, this isn't ideal since they need to repay the debt on a fixed schedule with interest. What if the new stores are not as profitable as the first? What if they take longer than expected to become profitable? These risks make taking on debt a very difficult and very concerning option. The second option is to bring in new investors. BIC can create and sell new shares of stock to raise that 80 lakhs. So the advantage of selling stock is that the money doesn't need to be repaid, but the trade-off is sharing future profits with more investors. So let's say the founders choose to raise the 80 lakhs by taking BIC public. The investment bankers tell them that, okay, you can sell 10,000 shares at 800 rupees each to the public, right? So the amount they need is 80 lakhs of rupees. They sell 10,000 shares at 800 rupees, right? So Alok, Divya and Rahul accept these terms and proceed with going public. So before this move happened, right, Alok had 6,000 shares, he had 60%, Divya owned 30%, and Rahul had 10%. So now the public is going to buy 10,000 shares, right? The public is going to buy 10,000 shares, which means the total number of shares now have gone from 10,000 to 20,000, right? So because of this, the whole ownership structure sort of changes a little bit. So now adding this public's 10,000 shares into the mix, you see that now Alok has 6,000 shares out of 20,000 shares, not the earlier 10,000. So which means Alok's ownership has dropped to 30%. Divya's ownership has dropped to 15% and Rahul's to 5%. And now the public, which has bought 10,000 shares, owns 50% of the company. So this way BIC secures the 80 lakh rupees needed for the new stores. And this example illustrates the main reasons companies go public, because they raise capital to expand their business. And this money can fund different needs for different companies. Some companies do it because they want to hire more people, some do it because they want to buy equipment, some use it for paying off debt, and similarly many more reasons. The trade-off of going public is that the original owners must share their ownership with the new investors, which is the public in this case. In this case now, Alok, Divya and Rahul own just half of BIC in effect. So basically this effect of where the promoter's holding goes down is known as dilution. So this is what happened, when Trent, you've heard of Trent, right? It's pretty popular because it's now become part of the Nifty, it's become such a big company. So they first went public in 1998. And at that time, Trent operated just 5 West Side stores. But its management team wanted to expand rapidly across major Indian cities. And to raise the money needed to build those new stores, Trent created and sold new shares to the public. So this process where a company goes and sells shares to the public is called an initial public offering, or IPO. So at that point, Trent issued about 25 lakh new shares of stock and sold them for 65 rupees each, which means they raised about 16.25 crores. At that time of the IPO, I think Trent's existing shareholders were diluted by about 15%. So the shareholders at that point were comfortable with this dilution because they believed that the money from the IPO would allow the company to build so many new stores and expand rapidly, and which would in turn increase Trent's value over time and generate good returns for the promoters as well as the investors. In simple terms, this short-term dilution would be worth it for long-term growth. So dilution happens when a company creates new shares of stock, which reduces the ownership percentage of existing shareholders. Companies go public for several other reasons as well. Sometimes the existing owners want to sell their stock. Going public through an IPO provides them this opportunity. So I get asked this a lot. Does the company get the money when an investor buys their stock? The answer is both yes and no. Now there are two different scenarios that happen. The first is an initial public offering. What we just saw is when a private company sells new shares of stock to public investors. After the IPO, these shares then can be bought and sold on stock exchanges like BSE and NSE. So let me try and explain this in simpler terms, right? So during the IPO, when BIC sold its shares through an IPO, it created and sold 10,000 new shares at 800 rupees each, raising 80 lakhs of rupees. This money goes directly to the company, right? Now after the IPO, once these shares are sold, they belong to the public investors who bought them, not the company anymore. These investors can then choose to either keep or sell their shares, right? So just remember one more thing. When investors later trade these shares on the stock exchange, the money from these trades goes to the selling investor, not to the company, right? So why do investors buy a company stock? What are the primary reasons, right? I think there's primarily just one main reason why investors buy stock, and that is to make money. And there are two ways that investors can make money by owning stock. The first is to buy the stock for one price and then sell it at a higher price. This is possible when a stock goes up in value over time, which is called appreciation or capital gains. So let's use BIC as an example, right? So let's say I bought some stock in BIC at the IPO for 800 rupees per share. You were not able to buy at the IPO, but now you want to become a shareholder. And you are willing to pay 1200 rupees for the stock. So let's say I sell my stock to you at 1200 rupees. So I bought the stock for 800 rupees, right? I bought the stock for 800 rupees and I sold the stock to you for 1200 rupees, right? That means I earned a profit of 400, which is a 50% return on my investment. Now this is called making money through a capital gain, right? So this appreciation or capital gain is when the value of an asset like a stock increases over time, right? So the second way that investors can make money by owning stock is through dividends. A dividend is when a company chooses to give some of its profits back to its shareholders in the form of a cash payment. We already saw an example before the company had gone public, right? So not all companies make dividend payments to their shareholders. Companies that choose to do so are generally called dividend stocks. Now in our example, let's say BIC has a great year, right? And it earns 16 lakh rupees in profits and decides to give all of that money to its shareholders by paying them a dividend. How much of that 16 lakhs will each shareholder get? So remember, let's go back to that Excel sheet we had, right? We remember that we had 20,000 total shares in the company, right? So with those 20,000 total shares, each share would receive 80 rupees. That's because the dividend we've decided to give out is 16 lakhs, right? And 16 lakhs divided by 20,000 gives us 80 rupees. And so here on this table now, you can see how the dividend is getting distributed. Alok with his 6,000 shares gets 4,80,000 in dividend. Divya gets 2,40,000. Rahul gets 80,000 and the public investors get 8 lakhs of dividend amount. all according to the shareholding pattern they have. So now we saw cases where you're making money via capital gain, and you also saw a case where you're making money through dividends. Now there are some cases in which you'll make money through capital gains as well as through dividends, right? So the bottom line is this: investors buy stocks to make money. So now I want to talk about the different types of companies you can invest in on the stock market. Just like you have different sizes of t-shirts, right? You have small, medium, large. Companies on the stock market also come in different sizes. And this sizing is based on their market capitalization. We've learned what market capitalization is, right? So basically the large cap companies, right? These are like the big players. They are established, well-known brands you trust. Think of them like as the heavyweight champions of the market. And in terms of market cap, they're worth more than 10,000 crores. They're usually industry leaders with very strong track records. And as far as investing in them is concerned, they're perfect for beginners or very cautious investors who want safer investments. They tend to give steady, reliable returns, like a slow and a steady marathon runner. So if we talk about the Indian market, we have examples like TCS, Reliance, HDFC Bank. These are like the bellwether stocks of the Indian stock market. So next we have mid-cap companies. Mid-cap companies, I call them like the growing stars. These are companies that are still in the growing phase, but in some ways they've already proven themselves. Their market value is anywhere between 1,000 crores to 10,000 crores. They have good potential to become large caps in the future, right? And they offer a nice balance between risk and potential returns. And they're usually good for investors who can handle some market ups and downs. There is a little bit of volatility, and if you can handle it, then mid caps is the way to go for you, right? So small cap companies. Small cap companies are like the future possibilities, right? They're usually very much smaller in terms of value. They're valued at about less than 1,000 crores. But the good part is they could be tomorrow's big success stories. They're like a little bigger than startup companies, but they have big dreams and potential. And their stock prices can change dramatically, both up and down. So that means they have much higher risk. But with that higher risk comes the possibility of much higher returns if that company succeeds. So in some ways, I would recommend small caps for more experienced investors who can handle risk and do thorough research. And remember, just like you wouldn't put all your eggs in one basket, right? It's often wise to invest in a mix of these different types of companies. And that decision should be based on your risk tolerance and investment goals. We learned a number of things today, so it's time to do a recap before moving forward. So first we learned that stocks represent partial ownership of a company. They give legal rights on profits and assets of the company to the stock owner. We also learned that stock market is a regulated marketplace where people buy and sell shares through exchanges like NSE and BSE in India. We also learned that indices track the overall performance of the stock market. Fourth, we learned companies go public through an IPO to raise capital, though this dilutes ownership of the existing shareholders. Then we learned when new shares are sold, the money comes into the company. But when existing shares are sold, the money goes to the selling investor. And finally, we learned that investors aim to profit through two main ways when they buy stocks. First is through capital gains, and the second is through dividend payments. So चलिए आगे बढ़ते हैं. So how do investors determine what a business is worth? So स्टॉक मार्केट में किसी कंपनी की वैल्यू डिसाइड करना बहुत इंपॉर्टेंट होता है, क्योंकि इसी से पता चलता है कि शेयर का प्राइस क्या होना चाहिए. So let's assume that BIC makes exactly 20 lakh rupees in profits. Now profits are also called earnings, right? So with 20,000 total shares that are outstanding, that equals 100 rupees in earnings per share. चलिए quickly एक Excel sheet बनाते हैं इसका. So formula for earning per share is EPS is equal to total earnings divided by total shares outstanding. So in our case it's 20 lakh rupees divided by 20,000 gives us 100 rupees per share. So let's also assume that the company's earnings never change. Year in and year out, BIC earns exactly 20 lakhs in profits. So now here's what BIC's financial will look like in 10 years. मैं 10 साल का बना देता हूँ चार्ट एंड लेट्स अज्यूम कि नंबर ऑफ स्टोर्स उसका एक ही रहेगा क्योंकि अर्निंग्स चेंज नहीं होगा तो 20 लाख रुपया अर्निंग्स एवरी ईयर एंड विद 20,000 शेयर्स द अर्निंग पर शेयर इज एट 100 rupees, right? It stays the same for 10 years. Not a very difficult sheet to understand, right? So how much would you pay to own one share of BIC? Let's assume you're only willing to pay 200 rupees for one share of stock. And let's say कोई BIC का shareholder मान भी गया आपको बेचने के लिए 200 रुपए में, right? So the formula for return on investment, let's calculate the return on investment. तो यहाँ पे मैं 2-3 scenario बनाने वाला हूँ. Let's call this scenario 1, right? So here EPS is 100 rupees और आपने 200 रुपए में शेयर खरीदा. So which means your return on investment is calculated as your yearly earnings per share divided by the price paid per share, right? Times 100. So in our case, return on investment is 100 rupees, which is your earnings, divided by the price paid, 200 rupees, which gives us 50%, right? So that's the first scenario. Now a 50% return on investment in 1 year is really, really high. After all, would you rather have your money invested in BIC earning 50% per year or have it in a savings bank account earning 3-4% per year? Right? This means that 200 rupees per share is a great purchase price for the buyer. However, when a purchase price is a great deal for the buyer, then it must also be a terrible price for the seller, right? So let's take it to the other extreme now, right? So let's say that you are so desperate to buy BIC stock, nobody is selling it. You're even willing to pay 1 lakh rupees for one share. And let's say, obviously कोई shareholder तो मान ही जाएगा आपको 1 लाख रुपए में, he'll happily sell it to you since you're so desperate, right? So you decide to buy it at 1 lakh rupees. So ये scenario में हम लोग return on investment calculate करते हैं. So do you remember the formula for return on investment? We just calculated it, right? That's yearly earnings per share divided by share price. So in our case, it's 100 rupees earning divided by 1 lakh rupees, which is the share price you've paid. So your ROI works out to 0.1%. With just a 0.1% return on your investment, why would you even bother buying shares of BIC? You could stick your money in a bank account and earn 3%, which is 10 times higher or 30 times higher. This means that 1 lakh per share is a terrible purchase price for you as a buyer. However, it also means that 1 lakh is a wonderful price for the seller. So what have we learned so far? 200 rupees per share is too low, 1 lakh rupees per share is too high. There has to be some balance somewhere, right? So let's try 1,000 rupees, right? Let's give 1,000 rupees a shot. So with EPS at 100 and price at 1,000, which is our third scenario, ROI is calculated again using the same formula. It comes to 10%. Now 10% return seems much more reasonable for both the buyer and the seller. The buyer earns a higher return than they could earn by keeping their money in a bank or in some kind of a bond or whatever. And the seller gets a decent price on the stock as well. Now, this is a very, very simple scenario in how stocks are valued. right? The price is determined by the balancing act between buyers and sellers. Buyers want as low a price as possible so they can earn a high future return, and sellers want as high of a price as possible so they can make the most money from their investment. So what have we learned? At any given time, investors determine what a business is worth based on two primary factors. The first is how much profit a company is expected to earn in the future. And the second is how much investors are willing to pay to buy those earnings today. What is the PE ratio and why is it important? You've heard buy low, sell high, but what does that really mean? When is a stock's price considered low? There's no perfect answer. But the PE ratio helps us understand if a stock is expensive or cheap compared to its earnings. It's like comparisons shopping. Just as you compare prices per kg at the grocery store, PE ratio tells you to compare stock prices relative to their earnings. Let's try and understand PE ratio a little bit better. Let's say we agreed that 1000 rupees per share is a fair price for BIC. We found that in the last section, right? So at this price, you as a buyer would earn a 10% return every year on your investment. Here's another way to look at it. When BIC earns 100 rupees per share, investors are willing to pay 1000 rupees for that share. This relationship between price and earnings has a special name in the stock market. It's called the PE ratio or price to earnings ratio. In simple terms, the calculation is price per share divided by earnings per share. So in simple terms, BIC stock is trading at 10 times earnings. Why? Because 1000 price divided by 100 earnings equals 10. So when you hear someone referring to a stock's multiple or earnings multiple, this is what they mean, price earning ratio. Now why should you care about PE ratio? So it's like I said, it's like a price tag that helps you compare different stocks. Think of it like shopping. You want to get the best value for your money, right? So let me give you an example. If BIC has a PE of 10, and let's say another ice cream company has a PE of 20, which one is cheaper? BIC, of course, right? 10 versus 20. You're paying less money for the same amount of earnings. Now you can even compare BIC with the whole market. Let's say the average PE ratio of all companies listed on NSE is 20. This means BIC at a PE of 10 might be a better deal than most other companies, right? But here's the catch. PE ratio isn't perfect. It's just one of many tools investors use. For example, it won't help you value new startups that are not making any profits yet, or companies in troubled industries. Like the formula is simple, right? I've explained to you once, just repeating it again. Just divide the share price by the earnings per share. But remember, in investing, right? Cheaper isn't always better. You need to understand why a stock is cheap before investing in it. So talking about PE, I was recently listening to a talk by Monish Pabrai. Do you know who he is? Monish is an Indian-American investor and businessman, best known as the founder and managing partner of Pabrai Investment Funds, which follows a value investment strategy inspired by Warren Buffett. He's also written a very interesting book called Dhando Investor. So in this talk, he's talking about his 10 commandments of investing, and one of them is his investment strategy of looking for hidden PE of 1 stocks. It's a very interesting concept, right? So let me explain it to you. So while many stocks trade at PE ratios of 40, 30, 20, 10, and so on, Pabrai looks for companies that have a potential PE of 1. But this isn't obvious immediately from current numbers. These hidden PE of 1 stocks are based on future earnings potential rather than current earnings. So he illustrates this with his Fiat Chrysler investment in 2012. He bought it at $5 or under $5 a share when the company was not making so much money, but that $5 per share earnings happened in 2018. And the result of this was his investment multiplied 7 to 8 times as that predicted PE of 1 materialized for him. So there are two types of PE ratios. The first is the trailing PE. This uses the earnings from the last 4 quarters and it reflects the company's past performance. And the second is the forward PE. This is based on projected future earnings and this helps investors gauge expected growth. So now that we've understood what the PE ratio is, let's try and understand how to use this ratio in investing. The first use is a valuation assessment, right? Now the possibilities are two. It could be high PE ratio or low PE ratio. Now if a high PE ratio exists, that may indicate that a stock is overvalued or that investors expect significant growth in the future. For instance, technology companies often have very high PE ratios due to the high growth expectations from them. Now, low PE ratio, on the other hand, suggests that the stock is undervalued or that company could be facing challenges. Investors might consider this an opportunity if they believe the company can recover. The second use case is a comparative analysis. Investors often compare the PE ratio of companies within the same industry to assess relative value. For example, if company A has a PE of 15 and a company B has a PE of 25 and they're both in the same industry, company A might be seen as a better value, assuming similar growth prospects. The third is a market sentiment indicator. Now here we're not talking about any single company's PE, but we're talking about the overall market's average PE ratio that can indicate investor sentiment. For example, if the average market PE is significantly higher than historical averages, it may suggest overvaluation and potential market corrections. So for example, like Nifty, we plot the PE of the Nifty and we see how it is compared to its historical values and assess whether the market is overvalued or undervalued. The fourth is growth expectations. A rising PE ratio over time may indicate increasing investor confidence and expectations for future growth. Conversely, a declining PE could signal waning confidence in the company's prospects. So what are the limitations of the PE ratio? While useful, the PE ratio has several limitations. The first is earnings quality. This ratio does not account for the quality of earnings. Now, we'll talk a little bit more in detail about the quality of earnings in a future section, but for now you remember that it does not account for the quality, like one-time gains, for example. If somebody has sold a property or something, there's a one-time gain that has shown up in the profits, that can inflate the EPS and show a low PE. There is sector variability. Different industries have different average PE ratios, making cross-industry comparisons misleading, right? So another limitation with PE ratio, if there's no earnings in the companies. Companies with no earnings or negative earnings cannot have a meaningful PE ratio. For example, if there's a loss-making company or if it's a new company that is still showing losses and still not broken into profits, these companies cannot have a meaningful PE ratio. I'm not getting into any specific company right now, but we'll get into this in future sessions. But as a homework exercise, I would recommend you to study the PE of at least 10 different companies and also check the PE of the Nifty or the Sensex and study the chart and see the range it is moving in over the last 15 to 20 years. So in the previous two sections, we saw how do investors determine what a business is worth. We also figure out what is PE ratio and how to calculate it and how to use it. Now moving on, let's see how a company's growth affects its value. So let's continue with our example of BIC. So imagine BIC makes 20 lakh rupees in profits every year. That means each share earns 100 rupees in profits. So let's say the company, as we had imagined earlier, has no growth, and the PE ratio is 10. So the price per share we calculate is earnings per share times PE ratio, which is 100 times 10, which gives us 1,000 rupees. Now, if BIC stays the same size and keeps making the same profit year after year, we'd say it's a no-growth company. With a PE ratio of 10, each share would be worth 1,000 rupees even after 10 years, right? But what if BIC decides to grow? Let's say they want to open 10 new stores. And here's how BIC's growth looks over 10 years, right? Let's change the number of stores. Let's say they add one new store every single year from here, right? So in year 2, they add a new store. In year 3, they add a new store. 4, 5, similarly up to year 10, they add new stores every year, right? Let's say each new store now makes a profit of 20 lakh rupees. So which means the earnings will grow year on year. The first year with only one store, they were making 20 lakhs. The second year, they'll make 40. The third year, they'll make 60. And so on and so forth until they end up making 2 crores of profit in year 10, right? Now, based on this, if the shares outstanding is only 20,000, the earnings per share grows year on year from 100 rupees all the way up to 1,000 rupees per share in year 10. Now, at year 10, if the PE continues to be 10, let's say, right, then the price per share will be earnings per share, which is 1,000 now, times the PE ratio 10, which means the price per share is now 10,000 rupees. So now let me ask you a question. Which BIC would you rather own shares in? The BIC that makes the same profit every year, or the BIC that keeps growing and making more profit each year? Obviously the growing BIC, right? Why? Because you'll make much more money as an investor. Now here's a tricky question. If we are willing to pay 10 times earning for a no growth BIC, shouldn't we pay even more for the growing BIC? The answer is obviously yes. Even if you pay a higher PE ratio for growing BIC, it's worth it because growing companies can share bigger and bigger profits with their shareholders. This is why investors often pay higher PE ratios for growing companies like tech startups compared to stable, no-growth companies like old manufacturing units. Let's do a quick recap of this section. First, the price of a stock is determined by how much profit a business is expected to make in the future and how much investors are willing to pay now to own those future profits. Second, buyers want to pay as low of a price as possible so they can earn a higher return, and sellers want as high of a price as possible. We also learned what price earning ratio means, which is found by dividing the price of a stock by its earnings per share. And lastly, we learned that a business that is growing is worth a lot more than a business that is not growing. So let's move on to the next section. We all know that stock market is always changing because prices go up and down based on how many people want to buy or sell stocks. These changes are influenced by things like company news, the economy, and world events. Let's try and learn how we as investors can make better choices in this dynamic environment. Earlier, we agreed that a fair price to earning ratio for the no growth big company that earned 20 lakh each year was 10, right? So in the real world, the PE ratio is not a fixed number. It changes all the time. Most of the time, the changes in the PE ratio are small. Every now and then, these changes can be large. So let's imagine two different news stories to see why the PE ratio might change, right? So the first hypothetical news story that I want to talk about, let's say Amul announces that it is going to aggressively expand its ice cream business and open outlets right next to every big location. This announcement would be bad news for BIC, right? Some consumers might choose to buy ice cream from Amul instead of BIC. That would make it less likely that BIC would earn 20 lakhs in profits each year. If you were about to invest in BIC stock and the Amul news broke, would you still be willing to pay 10 times earnings for that stock? The odds are good that you would not. This news would lower your belief in BIC's ability to produce those profits each year. It would make sense to demand a lower PE to offset this new risk. So how much lower of a PE would you demand? Now let's say you're now willing to pay only 5 times earning, a PE ratio of 5. In that case, the share price of BIC would get cut in half, right? For example, if PE ratio was 10 before and earnings was 100 rupees, the share price was 1000. Now at a PE ratio of 5 and earnings per share still at 100, your share price would drop to 500 because future earnings are at risk. So by paying just 5 times earnings, the buyer would earn a 20% return on their investment. That might be a high enough return to justify that extra risk you're taking now. So return is equal to earnings divided by price, which is 100 divided by 500 now, which is 20%, right? So in general, when bad news comes along, buyers are less willing to buy stocks. They demand a lower PE ratio, which causes the share price to fall. Now let's consider what happens when good news comes along. So let's take the second story, right? Now let's say BIC announces that it will start selling coffee and donuts with its ice cream to increase footfalls in its stores. Now let's assume there's a growing customers base for coffee and donuts along with ice cream. Now this announcement would be viewed as great news by BIC's investors. Selling coffee and donuts would make it much more likely that BIC will earn 20 lakh in profits each year. It will not only earn that, maybe even more, right? So there's a great chance for growth. If you're about to buy BIC stock, would you be willing to pay more than 10 times earnings? Odds are that you would, right? How much more would you as a buyer be willing to pay? Let's say that you would now be willing to pay 20 times earnings. So the PE ratio of 20 because you're so excited by the coffee and the donut news. In that case, the price of one share of BIC just doubled. So by paying 20 times earnings, the buyer is willing to accept just a 5% return on their investment now. However, BIC now has the potential to earn so much more higher profits. And if that happened, the value of BIC stock would grow over time. That potential growth would make the buyer much more willing to pay a higher PE ratio now. So in general, right, when good news comes along, investors are more eager to buy stocks. They're willing to pay a high PE ratio, which causes the share price to rise. So importantly, in both theoretical examples, BIC was the same business producing 20 lakhs in profits last year, or 100 rupees in earnings per share. However, news came along that changed buyers' and sellers' perception about the future profits. The PE ratio and the share price moved up and down in response to that. So in the last part, we saw how bad news could cause a company's share price to drop. We also saw how good news could cause a company's share price to rise. But what happens on days when there is no news, right? But most stocks you see that still go up and down a little bit, right? Why? Sometimes investors as a group feel a little bit more optimistic about a company's future. That optimism makes them willing to pay a slightly higher PE ratio to own the stock. In turn, the stock prices rises a little. Other times, investors as a group feel a little bit more pessimistic about a company's future, and that pessimism makes them demand a slightly lower PE ratio, and this causes the stock price to fall. So this is basic supply demand that is also working in the market, right? Somebody's coming and buying a large chunk of shares, price rises, somebody's selling a large chunk of shares and the price falls. As an example, Let's consider what happened to Reliance Industries on Thursday, November 12th, 2020, right? I just picked a random day from the chart. So Reliance didn't release any news on this particular day. Reliance started the trading day at 1,946, and over the course of the day, the stock dropped. It fell to 1,926, and before ending the day at 1,935. This small decline suggested that investors may be selling or feeling a little bit more pessimistic about Reliance's future as of that day. But importantly, there was no news to explain why this happened. For whatever reason, on Thursday, November 12th, Reliance investors felt pessimistic about the company's future. And then what happened the next day? The exact opposite situation happened the very next day. On Friday, November 13th, Reliance didn't release any news. It started the day at 1,938, which was a little bit higher than it closed the day before. And over the course of the day, the stock rose to 1,959 and ended at 1,955. The stock price increase suggests that the investors felt slightly more optimistic on that day, right? So these demand and supply of buying and selling is the most common reason why stocks keep moving up and down each day. So to understand why, it's helpful to think of the stock market as a live, ongoing auction. So as an example, let's say that a stock is trading for 1,000 rupees. Some of its shareholders are in a foul mood and place an order to sell at any price over 1,001, which is the current market price. Now this is called the asking price, which is the lowest price that a seller will accept for a security. Now let's say there are some investors who want to buy the stock but are not willing to pay 1,000. They will only buy if the price is 999 or less. This is called the bid price, which is the highest price a buyer will pay for the security. In this scenario, the ask price is 1,001 and the bid price is 999. The difference between those two numbers is 2 rupees, which is called the spread, which is the difference between the ask and the bid price. Now let's say that some of the existing shareholders are more eager to sell than the potential buyers are to buy. One of the sellers decides to accept the 999 bid price. The transaction goes through and the stock price falls to 999, which is the last price that the trade took place. In this case, the eagerness of the seller outweighs the eagerness of the buyer, causing the stock price to fall. The inverse can also be true. If potential buyers are more eager, then they bid the price up and the price rises, taking out the sellers and the price increases. Right? Very simple. Ask price, the lowest price that a seller will accept for a security, and the bid price is the highest price the buyer will pay for a security. This is how trading happens in the market. And the spread is the difference between these two prices. Right? Now, occasionally news comes along that causes investors to feel a lot more optimistic or a lot more pessimistic than normal. So consider what happened to Reliance's stock on Friday, March 13th, 2020, 8 months earlier. Reliance ended the trading day at 1,100 per share. However, large portions of India were shut down in that weekend because of COVID-19. Now that news caused investors to fear that Reliance's profits were going to fall in the future. Reliance's stock fell from 1,100 to 875 on Monday, March 17, 2020, in response to that fear. Now the reverse is also true. Good news can cause a stock to rise rapidly as well. So let's take Tuesday, August 25th, 2020. Reliance announced that Facebook would invest 43,000 crores in Jio platforms. And that news caused investors to believe that Reliance's profits were about to rise, and the stock went up 5% on that day, on Tuesday, the August of 25th. Right? So in all these cases, a stock price changes based on how investors as a group feel about the company at any given point, right? And that is why stocks rise or fall on any given day. Why does the market keep moving every day? Now we've learned that investor sentiment affects individual stock prices throughout the day. But the same principle applies to the entire stock market. The stock market index, like the Nifty or the Sensex, also has a PE ratio. We saw that earlier, right, when we were talking about PE. That also changes a little bit every day. The stock market fluctuates daily due to several factors that influence trading patterns, market sentiment, and external events. So let's quickly break these down and see why these movements occur. The first is supply and demand, right? The fundamental principle governing stock price movements is supply and demand. We also spoke about investor sentiment. Like market sentiment plays a crucial role in stock prices. When it's positive, it's lifting prices. When it's negative, the prices are falling down, right? What I want to talk about is economic indicators. There are several economic indicators which influence market movements. The first one is interest rates, right? Interest rates are set by the RBI in India. It's set by the Federal Reserve in the US. And these rates, when they change, they affect borrowing costs for companies and consumers, and they impact profits and spending for companies. They have major impact on the markets, right? We talk about inflation rates. High inflation erodes purchasing power and can hurt corporate earnings, leading to lower stock prices. There's employment data. The government constantly releases employment data, again in India as well as in the US, which has major impact on global markets. Strong employment boosts investor confidence, while high unemployment creates market pessimism. There are several external events which affect the market as well, and the stock market constantly reacts to these events. Political events, for example, elections, results of elections have major impacts. Policy changes, geopolitical tensions. If a war breaks out, for example, when the war in Ukraine versus Russia broke out, there was major uncertainty in the markets, right? Natural disasters, events like earthquakes or floods or tsunamis can disrupt business operations, affecting stock prices. There are also other major global events like major economic developments and happening around the world, right? These influence markets. For instance, OPEC has a meeting and oil prices change, or their strategy changes, or their pricing policy changes. All these impact not only stocks, but they impact commodities and impact energy prices and impact the economy as a whole. Now, corporate performances. There are very large companies in the Indian economy, for example, and their results have a bearing on the market. So when these companies come out with their earnings reports, so a better or worse than expected quarterly result can cause significant price shifts, right? There are major mergers and acquisitions which happen. These deal announcements often trigger immediate price changes based on new future value estimates. So all in all, the stock market's daily movements reflect the complex interaction between all these factors like supply and demand, investor sentiment, economic indicators, external events. So all this dynamic environment keeps the stock prices in constant motion and reflects changing investor views. Understanding these factors helps investors better navigate through market volatility. So why does a stock go up or down over the long term? So let's go back to our favorite company in the world, Best Indian Ice Cream, right? So let's pretend that Best Indian Ice Cream is always valued at exactly 10 times earnings. We did this before. I'm just going to go back and recap this quickly. So let's also pretend that BIC succeeds in opening up one new store every year, right? So each store creates 20 lakhs in new profits. So what would be the price of one share of BIC in year one? With 20,000 shares, the earning per share would be 100 rupees. At a PE of 10, the share price would be 1,000. Right? In year two, the earnings is 40 lakhs and the earning per share goes to 200 rupees, and at the same PE, the share price would be 2,000. Similarly, every year it adds 100 rupees more in EPS and the share price rises by 1,000, giving us 10,000 at the end of year 10. You can perform this calculation and find out. Yeah, we've done this sheet before. So the price of one share of BIC went from 1,000 in year 1 to 10,000 in year 10. If you bought it in year 1 and held it until year 10, you would have earned 10 times your initial investment. This is why a stock goes up over the long term. The share price follows changes in earnings. When earnings go up, the stock price goes up. When earnings go down, the stock price goes down. Of course, in the real world, the PE ratio is not a fixed number like we said, right? It is constantly expanding and contracting based on how optimistic or pessimistic investors feel at any given time. However, over the long term, the price of a stock always follows the earnings of the company. So let's take an example, right? Asian Paints. In the same time, you can see that Asian Paints stock increased from 45 rupees per share in 2000 to 3,200 per share by 2024. And here's what that chart looks like. Now I'm going to put both these charts together and show you how the price and the earnings per share have moved over the last 25 years. You can see that sometimes Asian Paints share price went up faster than its profits. This happened because investors were feeling very optimistic, and at this point the Asian Paints PE ratio expanded. Other times the share price went down or stayed flat even though its profits were rising. This happened because investors had already priced in that the earnings were going to increase, and at that point they started feeling pessimistic that the price may not increase further, and the ratio contracted. So while in the short term a stock can go up and down for any number of reasons, over a long term you can see that prices move up and down based on changes in earnings. Benjamin Graham, do you know who Benjamin Graham is? He's the teacher of Warren Buffett. He's written this very famous book called The Intelligent Investor. He's a very famous investor himself. He summed up this whole process very beautifully. He said in the short run, the market is like a voting machine, tallying up which firms are popular and unpopular. But in the long run, the market is like a weighing machine, assessing the substance of a company. The same force that moves a single company stock applies to the stock market as a whole. Right? This graph shows the historic earnings of the Nifty 50. Here you can see that how the earnings of the Nifty have moved in tandem with the price of the Nifty index. Very, very similar to what was happening in the stock. So now we saw how the Nifty is moving in tandem with its earnings, right? So, but somebody asked me, how often does the stock market go up, right? So earlier we spoke about how stock market goes up about 15% annually, right? That's true. We saw the data. But if you only look at daily stock price movements, on a day-to-day basis, the odds that the Nifty will go up on any given day are slightly better than a coin flip. For the US market, I looked at 150 years of data. I chose the US because the amount of data was very large. We have 150 years of data for the stock market. On a day-to-day basis, stocks rise about 52% of the time and fall 48% of the time. It's a coin flip, like I said. The odds improve when you look at the S&P 500, which is the US index, over a period of a month. The S&P 500 goes up 61% of the time and down 39% of the time. I've got a chart for you. You can look at the data here. Over a 6-month period, it goes up 66% of the time. Over a 1-year period, 69% of the time. Things get even more interesting when you look at longer holding periods. You can see, for example, at 5 years, 10 years, 15 years, and 20 years, right? As the holding period increases, the odds of achieving a positive return increase. You can also see from a 20-year graph that the S&P 500 has produced a positive return 100% of the time over every 20-year holding period in the last 150 years. That's incredible when considering all of the bad stuff that has happened in US history. The country has dealt with so many economic depressions, 2 world wars, pandemics, president assassinations, high inflation, civil wars, high unemployment, terrorist attacks, and yet, when stocks are held a long enough period, they have delivered a positive return 100% of the time. Stocks are risky in the short term, but become almost risk-free in the long term. But bonds, on the other hand, are almost risk-free in the short term, but become riskier in the long term. Let's quickly review this section on why the markets move up and down on a day-to-day basis and on a regular basis. Firstly, the PE ratio is not fixed. It changes all the time based on different factors like supply and demand, investor sentiment, and news that comes in on a day-to-day basis. In the short term, we learned that how stocks move up and down based on how investors feel about a company, right? We also learned that on a day-to-day basis, the odds that the market will go up or down is a coin flip. But as the holding period increases, your odds of making money increases. And to end this section with an interesting fact, there has never been a 20-year period where the US market has never produced a positive return. Why does the stock market crash? So even though the Nifty and Sensex go up over the long term, there are still noticeable dips every so often, right? On a chart, the general trend is up and to the right, but the line isn't straight. There have been plenty of downturns along the way. Every now and then, the stock market experiences a big decline. When this happens, it is called a market crash. To find out why the market crashes, let's go back to our best ice cream company example, right? So let's say that everything is going great for BIC in its first 3 years. New stores are opening. I'll just pull up the last sheet we worked on. Everything is going great. First 3 years, there's growth happening. They're opening a new store every year. And the table is showing potential share price increase, right? So like before, I've assumed that same PE ratio of 10 and projected the prices. And you can see that the EPS has gone from 100 to 200, 300. And the share price also has gone up from 1,000 to 3,000. However, in the company's fourth year of expansion, a pandemic appears. What happens? All the consumers start to shop less often. Business activity slows to a crawl. And company starts having a hard time paying its bills and has to lay off employees to save money, right? So if you were invested in BIC at this time and you saw all this happening, how would you feel? You would most likely be very scared. You'd probably think that BIC's profits and stock price is going to fall some more. And other public investors like you would probably be afraid too. Some of them would want to sell their stocks in order to get out ahead of the decline. Now what happens? That fear would make them willing to accept a lower stock price in order to sell quickly. And that sudden desire to sell at a low price would cause the share price to drop some more. And this is like a self-fulfilling prophecy or a domino effect, whatever you want to call it. The declining share price would cause the price to earnings ratio to fall in anticipation of the decline in earnings, and the market just crashes. The stock price just keeps falling. It goes into a free fall mode. So stock market crashes happen for the same reason. Stock market crashes usually start when something bad happens in the world. That event causes investors to become worried about earnings, which are about to fall, and that worry causes some investors to sell. That selling causes stock prices to fall some more, which causes even more investors to worry that stocks are going to fall. And that momentum feeds on itself until stock prices crash. Historically, there have been a wide range of events that have caused investors to fear a market crash was coming. The 1992 securities scam, the 2008 global financial crisis, demonetization, natural disasters, high inflation, too much debt, too much greed, financial crisis, and more. Here are the biggest stock market crashes in the Sensex over the last few decades. In each case, the cause of the market crash was unique, right? You can see the market has fallen anywhere between 30 to 60 or more % in a span of like weeks or sometimes months. And some of these declines it took years to recover from, such as the 2008 financial crisis or the dot-com bubble. In other cases like the COVID crash, the recovery was finished in just a few months. What's important to know is that stock market crashes are nothing new. They are a normal part of investing. Since they are always caused by human emotions, they are also unpredictable. History shows that the stock market crashes every decade or so. And the odds are good that it will continue to crash every decade or so into the future. However, the stock market is also always recovered from the crash. So why has the stock market always recovered from crashes? Earlier, we learned that the stock market always follows earnings. While the Sensex has always grown over time, earnings decline every now and then. We covered the various causes of those market crashes in the last section. However, despite all of the bad stuff that has happened, earnings have always recovered and gone on to reach new highs. Let's go back and continue with that big example from the last section, where in the fourth year the pandemic had occurred. Remember BIC's owners, their investment would have dropped as well, right? How do you think they would respond to such a huge decline in profits? They would probably make some drastic changes to get the company's profit back up. And what changes could they make? Here are a few ideas you could think of, like focus on online sales to enable customers to order BIC ice cream from home or through food delivery apps. They could start selling different things like kulfis and ice creams or milkshakes at the stores and through online to create new revenue opportunities. They could change the timings of the stores. They could open much earlier or close them much later. They could negotiate with their suppliers for lower costs, negotiate with their landlords for lower rents. This huge profit decline would force the owners to try new business practices. It's likely that some of these actions would help to reverse the big decline in earnings. What's more, the pandemic wouldn't just affect BIC. It would also impact BIC's competitors. Some of them would go out of business in the downturn. Their customers might choose to buy from BIC instead now. Importantly, these moves would probably make BIC a much stronger company in the future. Now let's imagine that by year 5, the worst of the pandemic is over and BIC's profits have recovered to say 10 lakhs per store, right? And let's say by year 6, BIC is back to earning 20 lakhs in profits per store. And by year 7, because of all the changes and because of the pandemic and they changed their strategy, BIC's profits per store might go all the way up to 30 lakhs. So here's what BIC's financial results look like over a 10-year period. You can see now that the 10-year EPS has gone up from 1,000 to 1,500 because of these changes in the financials. Now this is an overly simplified example, but it shows you how a company can recover from a downturn and emerge stronger on the other side. The stock market works in a similar way, and it has always recovered from past downturns and emerged stronger on the other side. So here are 3 big reasons why. First is, tough times force companies, workers, and entrepreneurs to try new things. They abandon old business practices and adopt new ones. Consider what happened during the 1991 economic crisis in India. The country was facing severe economic challenges. Yet this led to liberalization reforms that transformed the Indian economy and sparked decades of growth. Or consider demonetization in 2016. That's very recent, right? While it caused short-term disruption, it accelerated digital payments across India. Companies that adapted to digital transactions thrived in the new environment. In 2020, the COVID-19 pandemic caused millions of businesses to shut down. But video conferencing, work from home, and e-commerce became the norm. Companies that adapted to meet these new needs of the market not only survived, but they set themselves up for long-term success. When tough times hit businesses, they are forced to innovate and try new things. That innovation leads to new business formation. That leads to a recovery. Second, Weak businesses go belly up in tough times, but strong businesses survive. The strong businesses eventually capture the customers of businesses that failed. That allows them to emerge stronger than ever before. Third, the government and RBI step in to provide assistance during downturns. This includes providing employment opportunities, or buying goods and services from businesses, or providing stimulus to the economy that can help to cushion the economic blow. These three factors combined eventually end the downturn. The businesses that survive emerge stronger. Profits eventually fully recover and rise. New businesses also start to pop up and grow quickly in a recovery. The new innovations and technologies they bring to the market drive the economy. Eventually, investors recognize that earnings are recovering, which reinflates stock prices. In other words, as long as profits eventually recover from a downturn, the stock market will too. So part 5, earnings, right? So we've talked a lot about how stocks and markets are driven by earnings. We also learned a little bit about how to go about finding stocks, how to discover them, how to do some analysis and learn about them, right? So now let's dive into the world of earnings and understand why they tend to rise over the long term. So simply put, earnings are the money a company makes from its business, right? So it is the company's profits it makes after taking out all of its expenses. So when you invest in a company, it's crucial, it's very important for you to know how much money it makes and whether it can keep making that money in the future. Now this is true whether you're just starting to invest or you have been doing it for years. Understanding these earnings will help you make better choices for investing, so you can improve your returns over the long term. So primarily, what do I want to cover today? So we want to cover what are the main dimensions, what are the main different types of sides of earning basically, what are the growth drivers for these earnings, and then finally we'll sort of learn how to evaluate the quality of earnings, right? So let's start with the first. Let's start with understanding earnings, right? So when analyzing any company's financial performance, there are two fundamental dimensions we need to carefully examine, right? We need to understand them. Now these will help you build a complete picture of how the company's financial health is doing and its future prospects. The first is the size of the earnings. So how much a company actually makes in terms of profits, which directly reflects its current financial performance and market position. Right? This is typically measured through various metrics like it's called net income, operating income, and earnings per share we've talked a lot about. So if we break it down to the nuts and bolts level, like if I have to break this whole thing down, there are two primary things that can increase for a company. The first is the sales volume goes up, right? Simple, right? So for example, Cadbury chocolates, they increase their sales from 100 units to 150 units. The price stays the same, just number of volume has increased, right? So the earnings also will grow proportionally because now the sales has gone up 50%, the earnings will go up 50%. And the second is increasing product prices, right? Companies can also boost earnings by raising prices of their products or services. However, this strategy typically works for companies which have good, strong market positions. Like if you think about like a Nestle or a Cadbury, we spoke about how Maggi, for example, right? They kept raising the rates and they kept reducing the quantity. We called it shrinkflation. So for example, when Maggi sells 1,000 units at 11 rupees versus 10 rupees, that's a 10% increase in sales, right? So these are the two primary drivers of the quantity of earnings, the size of the earnings. The second point I want to talk about, which sort of the dimension of earnings, is the quality of the earnings. Now the quality is, while this is a bit more subjective to understand and interpret, but it is very, very crucial. So quality of earnings means that not all earnings are equal in value. So two companies may have similar earning numbers, but their quality can differ significantly based on their industry and business conditions. So let's take an example, right? Let's say there's a company A and a company B, right? Now both these companies are showing annual profits of 100 crores, right? So company A generates these earnings consistently through its core business operations. It has stable cash flow and the revenue is very predictable. You can predict कि future में क्या होने वाला है earnings का. So on the other hand, company B achieves the same profit figure, but it's achieved through some one-time asset sale कर दिया इधर, aggressive accounting practices, and while basically what I want to say is that while both their final figures, their final net profits, bottom line numbers, they call them bottom line numbers, they look identical. Company A clearly has better quality of earnings and that is more likely to persist in the future, right? So there's another example we can look at is company A, let's say, whose earnings have been growing year on year consistently for 5 years. They've been growing at 15% or 20%. And then we have a company B that has flatlined at same 100 crores for last 3 years. Right? This is another scenario. And the company B, we also realize, is in a very competitive industry. The pricing is aggressive. They're not able to raise prices. So based on this, again, just from purely understanding the businesses and how it has progressed, how the earnings have progressed over the last few years, you can say, you can know that if the earnings are not consistent or consistent, if they're predictable or not random, and if they're coming from normal business activities, all this information will help you figure out if the company can keep making these profits in the future and whether it has room to grow. So this is how you sort of analyze what the quality of the earnings of the business are. So now let's look at how the companies grow their earnings over time, right? What are the main drivers? I think the first main driver of earnings is typically inflation. We've heard about inflation. We talked about inflation earlier, right? Basically, it's prices going over time. So if prices go over time, product prices also will go up over time. So basically what happens is when inflation happens, so if you're in a particular business, the cost of raw materials goes up. The wages or the salaries you have to pay, those also keep going up year on year. Now, if there's logistics involved, if you transport your product to some place, then obviously transportation cost will go up. If the cost of oil goes up, etc. So everything keeps going up over a period of time, right? Because as these production costs keep going up, the company keeps moving these, passing on this cost that is happening to them. What they're incurring. So the company keeps passing on this cost that they're incurring to the customer, which means the cost of the final product also keeps going up. So we saw it with, our Chota Thumbs Up example when we spoke about it in the beginning. It was at 5 rupees 20 years ago, now it's 20 rupees. So obviously it's the effect of inflation, but it's not because the price of the product itself has increased, but rather all the components that we spoke about, like raw material, wages and transportation, everything has gone up, which has taken the price up. So this is typically inflation as a driver affects all companies, right? The second, I think, is more important, and this is what drives good companies to increase their profits faster, and that is called pricing power. Now, pricing power refers to a business's ability to increase prices without losing customer demand. I think the best example is you can see Apple, right? They have been able to raise the prices of iPhone every single year on year. It's gone up, like, I think when you first started in 2007 to now, it's gone up like multiple fold. And customers will still buy them. This shows strong pricing power. However, on the other hand, like if you see a budget airline, like for example, let's say SpiceJet, if they increase fares by just 10%, what will happen? Will customers still use SpiceJet? They're more likely, I think, to switch to another airline. You mean because you don't care about the price, you want to just get from point A to point B on a budget airline. And if there are three of them, you will choose the cheapest. That is your, criteria for picking the airline. So basically, companies with unique products or strong brands typically have high pricing power. And since customers have few alternatives, they must pay the prices charged. So, and in contrast, where companies have faced weak pricing power and there are competing brands, they're not able to do that. To understand this concept, you can ask yourself, what would you do if a company raised its prices? Would you continue buying anyway, or would you switch to an alternative? So, I mean, you can see this example again in like other brands like Parle G biscuits, for example. They've been able to keep raising prices and reduce sizes and increase prices far faster than the cost of inflation, right? So we said companies with unique products or strong brands typically have high pricing power since customers have few alternatives, right? So, I mean, to just quickly summarize all this information, let's look at this table where what gives the company pricing power, right? The first is a rare and a unique product, right? If the product is rare and unique, you have pricing power. Second is few rivals in the market. If there are too many competitors, then it's a bit of a problem for you to charge higher prices. Third is scarcity of resources of a raw material, right? If the raw material, for example, is easily available, then a lot more people will have access to that and be able to make similar products. Fourth is having that strong brand. If you built a brand around your product, then people are more likely to stick with it. And then finally, we have, if all this like falls into place, you have high pricing power and you're most likely to become a monopoly in that space and get the maximum market share, which actually drives earnings in the long term. So now let's quickly go through other factors that have an impact on the growth of earnings for a company, right? The first is productivity improvements. Companies are always finding ways to work smarter, right? And that's a great sign, that's a good sign for a company. And they do this by using technology to do routine tasks, they find better ways to deliver products, they're building new tools to work faster. While these changes may be small, they help these companies make more money by spending less and working more efficiently. The next I want to talk about is innovation, right? Innovation is, I think, a major factor which has transformed earnings over the years for many new companies, especially when new products and ideas is one of the ways companies can really capture a market. Like, look at smartphones, for example, right? In 1990, they did not even exist. Today, they're a $700 billion business. When companies come up with new ideas or solve problems in creative ways, they can make money in completely new ways. Like, I mean, for Amazon is another great example that came and transformed the way business was done, and now you can look at it, what has happened over 20 years to it, right? Third is geographic expansion. Companies can grow by moving into new countries or new places, right? Netflix is a great example, I think. It started as a DVD rental service only in the United States. Then they became a streaming service. But once they became a streaming service, they took their service to different countries and they've become a global service with more than 200 million subscribers. So by expanding like geographically, they're able to make more money while using what they already know how to do well. So that's another sign of businesses that are most likely to grow faster and bigger. Another point is acquisitions, right? Do you know what an acquisition is? An acquisition occurs when one company buys majority control of another. Let's consider like a company, let's call it Chai Master. It's a growing chai stop chain, right? Instead of so what Chai Master does is, instead of building new outlets from scratch, what it goes is, I mean, if you have to build new outlets from scratch, what would happen? It would require finding locations, hiring staff, dealing with regulations. What it does is, it goes and decides to acquire existing tea shops in different parts of the city and then different parts of the state and different parts of the country to expand quickly and build a chain, right? So when a company acquires another, it gains control of the target's revenues, profits, and operations. So it could go, I mean, there are different models for it, but I don't want to get into the details of that right now. So basically, companies pursue acquisitions to gain valuable assets in infrastructure, and they can increase their market share and reduce competition. They achieve cost efficiencies because they're able to sort of expand based on the knowledge they have, and they're able to go and acquire talent, technology, and new markets through this, right? I think one great example I can think of right now is Zomato, right? Zomato acquired Blinkit for about 4,500 crores in 2022. Now, this gave them instant access to quick commerce capabilities, right? They were not in that area of business, and they got an entirely new area, which is like one of the fastest growing spaces in the country right now. Similarly, like Tata Motors, I don't know if you remember, but in 2008, they acquired Jaguar Land Rover, right? That transformed them from an Indian automobile company to a global luxury car manufacturer. So these are some of the examples of how acquisitions can transform a business. If you heard of acquisitions, I'm sure you've heard of the word mergers, right? So now what mergers means is, it's very similar to acquisition, but it involves two companies which are combining as equals. In an acquisition, there's one company that's bigger and the other smaller. In mergers, there are two companies that are equal that combine to form a new entity or a new company. So this combination really aims to like combine their resources and capabilities. It increases market presence, and it sort of brings in operational efficiencies. A good example, I think, is recently when HDFC Bank and HDFC got united to bring their banking services and their whole lending business all into under one umbrella, right? So that's what mergers are. So now let's move on to the next section, which is evaluating the quality of earnings, right? We spoke about the quality of earnings. We said quantity or size of earnings is one aspect, but quality of earnings is as important, if not more, when you analyze a company. When we analyze the quality of earnings, what we aim to look at is the health of the overall industry and the company. And the way you do that is you ask a bunch of questions, and you ask that to get through this process, right? First is you look at the industry as a whole. So you look at like things like, is the industry large? Is it growing or depleting? Is the industry too competitive? Is there any risk of survival, right? Our goal here is to find if the industry is experiencing growth or contraction, and what are the long-term trends shaping its future trajectory. Right, when it comes to the business or the company, right, we check, is the company competitively strong and well positioned? Is the company's sales sustainable? Is there any major survival risk the business faces? Is it run by able, good managers? Does the management team possess the vision and the experience and track record to guide the company through challenges and opportunities, right? Our goal basically here is to find, how does the company's position competitively, how does it stack up against all the current rivals and possibly potential new entrants in the market, right? Then you also need to sort of look into the financials. Does the company generate strong profitability? Is the sales growing? Is it growing year on year? Has the company taken on too much debt, or is there any major liability coming up? Are they too aggressive in their approach to the business, right? So our goal really here is to find if the company can maintain or improve its sales. It needs to improve its sales performance over time for it to become a viable investment. We've learned that. So, and this it's doing in a very competitive market space with a high pressure environment. So they should be able to do that in the current business environment, right? So basically, we've looked at this section on earnings as such. So what we've learned is when evaluating a company's earnings potential and its financial health, it's essential for us, it's very important for us to conduct a complete analysis. And that complete analysis, I mean, you need to examine both the quantitative, which is the size of the earnings, and all the qualitative aspects, right? And this dual focused approach will help you as investors make more informed decisions about your investments. So great, let's move on to the next section now. So let's talk about how to find good stocks to invest in, right? As a regular investor, we are constantly looking for opportunities to invest in stocks. We always want to find new stocks, and everybody asks me, how do you go about finding it? Because how do you think, where are the new opportunities? Where do you invest it? So today I want to talk about how we can use some simple ways to spot good investment opportunities that even the pros generally miss, right? So finding good stocks doesn't follow a strict set of rules. It's not like you follow like a cookbook recipe and it's a checklist. It's more about a skill you develop, like a good chef, right? It's about timing. It's about skill. So good investment ideas can come from everyday life and the world around you. And the key is really to pay attention to changes. Changes, you see the changes happening in your daily life. You go about doing so many different things, right? That the other day I was just chatting with a friend and he was using this new fitness app and talking about it. So you know that when people start using certain services or certain products, that this is something that's new in the market. And just keeping your eyes and ears open for such new ideas is really the first step. So as you practice this, finding these investment ideas will just become second nature to you, right? So let's look at some simple ways that how we can go about doing this. Like it's a set process. This is actually a process that Peter Lynch, he was a famous investor in probably the late 70s to the early 90s. He was the fund manager at Fidelity. He sort of set the tone for this process and he became very, very successful with it. And he said this is really simple and anybody can follow this, right? So let's go to step one. First step is use your job knowledge to find good investments. So basically, what it means is whatever work you're doing, right? Your area, you have built a certain amount of expertise, a certain amount of knowledge around that particular job you're doing. Your expertise really lies there. So you know that industry really well. And this knowledge can help you spot very good investing opportunities, right? So think about it this way. A doctor, for example, he knows a lot about healthcare companies and new medicines because that's his daily work. He can really go about spotting which companies are doing well, what treatments look promising, right? So similarly, like a computer scientist, a data scientist, for example, he knows which AI and tech companies are creating the best products right now because they work with these technologies on a day-to-day basis. Even if you're a small business owner, like let's say you're running a small shop or a small factory or into textiles, whatever you're into, right? You have valuable insights about that particular space. Like you know directly which suppliers are working, which shipping companies are doing well. So you can actually go about finding more about these companies, especially if they're in a listed space, and go and do a little bit more research and understand them more, right? So this is really your first step of starting. So basically the key point is simple. Your job gives you special knowledge about your industry. You understand things that others will miss. And that's why looking for investments in your own field is a smart place to start. You're less likely to make mistakes in an area you know very well, right? So like I said, this idea really comes from Peter Lynch, right? He was one of the world's best investors of all time. And his simple advice, if I have to put it in a sentence, is invest in what you know and understand. It's that straightforward. So once you sort of understand that there's an area of expertise, right? The next step really is, how do you go about finding investment ideas in your daily life? So you can find good investment opportunities just by paying attention to the products and services you use every day, right? Many of the brands we use regularly on a day-to-day basis have been part of our life for years. Like, think about it this way, for example, right? You've been eating Maggi noodles, right, for so many years. I'm sure your kids also are eating it now. And Kit Kat chocolates, for example. Since you were young, right, all this has been around for like 2-3 decades perhaps. And you think you'll keep buying them for the next 5 years? Yeah, you're buying them for your kids as well. So these products might be worth looking into as investments, for example. You can find, what I mean to say is you can find many investment ideas just by noticing what's around you, the food you eat, the car you drive, where you shop, the ads you see. So look, like for example, like you wake up in the morning and you brush your teeth. Do you know the products you use? Perhaps like a Colgate toothbrush and Dabur toothpaste. You have tea in the morning or coffee, right? Like, the products that you use, perhaps from Tata Tea or Nescafe, for example. You eat breakfast, like puris for breakfast. You use Ashirwad, or you go shopping. You go shop at a West Side or a Zudio. From Trent, you drive to work in a car, which is perhaps from a Maruti or a Mahindra. You go and bank, right, with the particular bank you use, like ICICI or SBI or HDFC. Right? These products and services are part of our daily routine. We use them almost every day. And because people tend to stick to their habits, these companies often do well over time. But remember, just because you like a product doesn't automatically make it a good investment. You still need to research the company carefully before investing your money. So, learning from what you see. Again, Peter Lynch came up with a simple but powerful way to look at these good investments. Just look around you. Anyone can do this. But you need to put in some time and effort and basically some, headspace to do this. So the next point I want to talk about is learning from what you see. Now, the first two was in the area of work you do and the daily life, right? But here, this is being a little bit more proactive. If you want to go and find more ideas, you need to sort of get out of your comfort zone and maybe just go out and look for ideas. Again, Peter Lynch called this legwork, right? It's actually going around and finding investment ideas more proactively, right? Again, anyone can do this. You just need some time and effort. So the basic idea is very, very simple. You perhaps, you can go to a shopping mall, right? And you go and notice what kind of products people are buying. Which stores are they visiting? Where are the longest lines in? What stores are the longest lines in? What services are being used? These observations, for example, can give you good investing ideas again, right? So, like I said, shopping malls, right? Which restaurants, for example, there's a food court with so many brands of restaurants. You can also find out what stores are closing down or doing badly. So, if you have an investment in something and it's not doing well, you can find those red flags as well, right? Another interesting place he talks about is, like, if you go to a construction site, you can see so many different brands of material being used. Like, which companies are making these construction equipment? What vehicles are being used to move the materials around, right? Another great example, I think, is when you travel, when you go on a holiday. You're on a holiday, your mind is clear, you're not thinking about work. That's a great place to actually, do an exercise where you can actually find products that are popular in different places. You can also see what kind of apps are being used to book your travel, which hotel chains are people preferring, what luggage brands you're seeing at the airport, right? So this, you will get a lot of ideas, but you don't have to invest in every company you notice. All you're doing is helping you spot trends and successful businesses. Okay, so because most people won't take the time to do this research, which gives you an advantage, right? Like even Warren Buffett says, he's one of the world's best investors, right? He says he only finds like 2 to 3 really good investment ideas every year. So basically by doing this, you can prepare, you have a larger list that you have. From there, you can go on and do more research, and you can start shortlisting and learning a little bit more about these companies. And this way you can like bring down that list and figure out what would be the best companies to finally go and invest in, right? So uh, the next point I want to talk about is, how can one go about reading and understanding investment in the news, right? So reading newspapers and magazines, for example, can help you find good investment ideas. But you need to be smart about what you read and how to use this information, right? So when reading about investments, you can focus, I think the focus needs to be on facts about companies and industries. You need to start skipping those dramatic headlines and market predictions, right? You look for important company updates and changes. Also, be very careful with the news resources because many news outlets these days can be very biased. Newspapers often have too much market noise, and following unreliable news can lead to poor investment choices. So, the next section I want to talk about is how you can go about picking stocks using a stock screener, right? So, to scan for stocks in the Indian markets, one can use a screener like screener.in, right? It's free to use. The screener comes with ready-made filters and you can add your own. For example, you can go look for companies that are paying good dividends, companies making steady profits or strong growth with reasonable prices, right? Like let's explore companies with like high dividend yields for as an example, right? You can customize the screening conditions to match your investment criteria. So this is how the conditions will look like, for example, right? Like if I say profit growth for 5 years greater than 10%, or average 5 years dividend greater than 2%, or I can even put a condition like PE less than 30, right? So there are several conditions and you can just play around with it and figure out like how to use the tool. And as you learn a lot more to do with fundamental analysis, you can start using better conditions and criteria to sort of filter out stocks here. I want to talk about some of the important things that you need to remember when you're using screeners, right? So let's just go through them one by one. The first is, don't just trust the numbers, right? Sometimes company earnings can look better than they really are, right? If there's window dressing involved, if the numbers have been tampered with, the numbers can look good, but the company really may not be so good. So again, I'm saying unless and until you know the company, it's better to really not get into to investing in it in the first place, right? So the next point is, watch out for warning signs. So by watching out for warning signs, I really mean is be careful with companies that are not making money. If they're not making profits, or the profits are very erratic, or if the company has too much debt, taking too many loans, right? Avoid stocks that seem too expensive. Like for example, P is very absurd levels. Yeah. So look at multiple factors and not just one number. Don't get fixated on any single number and say, okay, I'm just going to follow this. So another good habit to develop is keep track of how companies are doing over time. Be patient. Good investments take time to grow. So the next point I want to talk about is getting investment advice from others, right? This is very common these days. There are a lot of people giving stock recommendations all over the place. But I think when it comes to getting recommendations for stocks, you should keep it very simple. Talk to just 3 or 4 people you trust, right? Pick friends who do their homework before investing and really understand how the market works. And you need to always ask them, have you researched this company yourself? So when someone suggests a stock to you, always ask them why they like it. If they give you clear reasons based on common sense, research, that's good. But if they just say, I heard about it somewhere, or someone in a chat group mentioned it, it's best to ignore those advice, right? Another place you can also learn from are brokerage reports if you can get access. A lot of brokers publish reports, and these are written by analysts who have special access to company information, right? While you shouldn't blindly follow their buy or sell advice, these reports contain useful facts that can help with your research. When it comes to investment advice, a lot of people ask me about stock tips, right? Can you give me a stock tip? So I think that's something you need to absolutely avoid, right? And why I think you should avoid stock tips? They're obviously like shortcuts and I think they generally lead you nowhere. And I'm telling you from experience, I have followed stock tips in the past, and I find that they're dangerous. For one, tips only tell you when to buy or sell, right? And good investments usually like need about 3 to 5 years to grow at the minimum. And so if somebody has given you a tip, and if you lose touch with that person who's giving that tip, or it's come from a third person, somebody knows somebody, then you're never going to know the reasons, or you're never going to know when to get out of the stock. So if you don't know when to sell or how to act because it's not from your own research, then you're always going to be in trouble on how to manage that investment. So also think about it. If these tips were really valuable, right? Why would anyone share them? So if somebody is not, it's not coming from your own research, for example, it's coming from somewhere else. So without any knowledge, what's going to happen? When the market falls, if the stock moves erratically, you're going to panic. And when you're going to panic, you're going to sell when the prices drop, which means most likely these investments will end in losses. This is what happens to a lot of these tips. So I personally think one should completely avoid this zone. And always remember, the most important rule is to do your own research. Even when people are giving you advice, even when it's coming from people you trust, always do your own research on that company and find out whatever information is possible. And only when it's viable, when you think that, okay, this is a great idea, I think this is going to work, only when you're convinced should you make the choice of investing in a company that has been recommended to you. So we talked about how to go about finding good companies to invest in, right? Now, once you find good companies, how do you go and find more information about these companies, right? So let's look a little bit more into that. So when researching companies, you need good information to make those smart decisions, right? And I want to give you a list of possible sources where you can go and find this reliable information, right? So let's look at this, the information sources for a company. The first information source I want to talk about is the annual report, right? So the annual report, I think, is the most important document a company releases each and every year. It shows you how well the company is doing. And it includes several things, the most important being the financial results. The financial results has several different financial documents. One is the profit and loss statement, another is a balance sheet, and then we have the cash flow statement, right? We're not getting into a detailed analysis of this. This is a separate subject in itself, and we will definitely cover this in a future video. Next, we also get a lot of information about how the business is running, what the company has achieved, any risks to watch out for, plans for the future. You get to hear from the chairman, the managing director of the companies, and you get to learn a lot about the company through these statements and through these documents that are available in the annual report, right? Next, we can look at investor presentations. These are usually available on the company's website, right? Here, the company creates simple slideshows that explain their business. So here, you see important facts like how big the company is, how much they're selling, what's happening in the industry. Again, very, very crucial information about the business. So, and then when every quarter the company releases its results, they have conference calls. Usually these numbers are available and you can join these calls. Most of the time it's these analysts who go in, but investors who are serious about a company also can join a call and listen in, right? Here the company holds meetings where investors can ask questions. The company first talks about how they're doing again and then answers these questions from investors. You can read what was said in these meetings online as well. You get transcripts of these, right? There are also, I think another great source is interviews. You know, company leaders often talk about their business on TV news channels. There are interviews and podcasts on YouTube where they go and talk to different hosts. You get very interesting information about the people behind the business and how they're running it and the culture in the company and so on. Then we have the IPO documents. The technical name for it is called the DRHP, which is the Draft Red Herring Prospectus. So basically, when a company first sells shares to the public, right, they must share very detailed information about their business. These documents are very thorough and helpful, and even for understanding much older companies as well. So from that perspective, this is a very detailed document and you get to learn a lot about companies when they come out with this red herring prospectus. So then I want to talk about the corporate. There are a number of corporate announcements that the companies make sometimes on a daily, weekly basis. And these are reported as soon as they're made on the NSE and the BSE website. So here the company tells investors about important changes, right? So you can find these updates readily on the stock exchange websites. And what do they include? They include like new things, like if there's a new business they're entering, if they're buying into any new companies, if there are any changes in the management team, right? Or if there are any other important notices that they need to inform the investors. All this comes in corporate announcements, right? So there are a bunch of other reports as well, which is one is the industry reports. Industry reports are research companies which study entire industries and write reports about them. And these are more on the industry of the business. So these reports will help you understand how different sectors are doing. Then we have broker reports, like we were talking about, where stockbrokers write detailed reports about companies. Again, I think you should not follow their buy or sell advice blindly, but these reports contain very useful facts. And then we have reports that are made by government and government agencies, which sort of provide reliable information about different industries. And these are very trustworthy sources of research. So there are some sources that you need to be careful with. And first is blogs, right? Blogs are generally very opinionated articles. You don't need to rely on them for making investment decisions, but you could look at them as a discovery process. Also, news articles, I think, again, could be biased, opinionated. You need to be careful when you weigh in and see the information, and just don't buy everything you read, right? So let's do a quick summary of this section. So we've talked about how to find good stocks to invest in, right? So here are some of the key methods that we've used to generate good ideas for investment. First is, your professional expertise. Use knowledge from your own profession and industry as it gives you an advantage. Then we spoke about observing your environment you live in, right? You pay attention to products and services you use daily, and from everyday items to regular services, etc. Then do the legwork, which is actively, if you want to go out and find more information, then actively explore different environments like malls, construction sites, travel destinations, etc. to generate some ideas. And we talked about looking at research tools and using them like stock screeners to filter companies based on specific criteria. And then using only trusted sources to find recommendations for stocks. And finally, we looked at what are the most important sources of company information. We looked at annual reports, investor presentations, conference calls, red herring prospectus, interviews, right? Now, these sources and this method will give you all the tools you need to do your own research and find good stocks to invest in. Now that you've been on this learning journey with me through this video and know how to get started with your investing, let's address some common questions and mistakes that many investors encounter. Understanding these pitfalls can help you avoid costly errors and make smarter investment decisions. Let's dive into these questions to ensure your investing journey is a successful one. First question is, should I stop investing if the economy is doing badly? I think we've addressed this at length during the section on why markets crash and how they recover, but let's try a different take on this, yeah? So imagine it's January 2008, during the peak of the global financial crisis that severely impacted India. News breaks that large US banks such as Bear Stearns and Lehman Brothers are failing. Home foreclosures or home loans in the US were again defaulting, and the defaults were just skyrocketing. The US markets just plunged, fell very badly. And India faced a domino effect. The Sensex crashed. At the same time, there were frauds detected in blue chip companies like Satyam. Real estate prices also started falling sharply, and everything went into a free fall. What did this result in? Unemployment started rising, and each day was bringing worse news than the previous. The Indian economy slowed down significantly. Companies started freezing hiring. Banks became more cautious with lending money, which meant business activity just stops because banks don't lend money, businesses don't get money to sort of run their operations. People are worried about job security and they start spending less. Stock market investments also lose value, so people again are not able to sell their existing holdings, right? This whole situation becomes so severe that the RBI and the government then had to introduce multiple measures to prevent an economic collapse. Would you be interested in buying stocks? For most people, the answer is no. They would be paralyzed with fear. And yet, the best time to invest is when the economy is doing terribly. I'm going to repeat it again. The best time to invest is when the economy is doing terribly. Don't believe me? The returns from the Sensex are highest during periods of economic distress. The returns from the Sensex are lowest when the economy is booming and everyone is optimistic. You say, how could this be? Right? When the economy is struggling, the stock markets has usually fallen significantly. This means that the PE ratios, if you see the PE ratio graph of the Sensex over 25-year period, it's lowest during these periods of distress and stocks become really cheap. When stocks are cheap, future returns tend to be higher. And the exact opposite is true when the economy is doing well. Investors are confident, so the stock market rises, which means PE ratios keep expanding and stocks become more expensive. So this is why it's a terrible idea to stop investing when the economy is doing badly. If anything, you should just try and invest as much more as you can as possible. The next question, which is a very common question I get in the market all the time, is should I try to time the market? Let me just go back and tell you a little bit of history here. So between November 99 and October 2024, that's how many years? 25 years. The Sensex grew from 4,700 to 80,000, which is a return of 1,700%. That means your capital multiplied 17 times over these 25 years. However, the returns were anything but smooth, right? The Sensex started November 99 at around 4,400. Then the dot-com bubble hit and the Sensex dipped to 2,600. The market recovered strongly between 2003 and 2008 and Sensex reached 21,000. That's when another global financial crisis hit the market and the stock market plunged. From 21,000 we saw 8,000 levels. But then from there again it's recovered and it's gone to 85,000. Wouldn't it be a great idea to sell every time before the stock market declined and then buy back at the bottom? If you could do this, your returns would be huge, right? So many investors try to predict the stock market's highs and lows. This is called timing the market, right? I know how tempting this logic sounds, especially when you're looking backwards at stock prices. When you're looking back, it's easy to identify where the highs were and where the lows were. Unfortunately, it's impossible to figure out where the highs and lows are in real time. That's because there's no way to tell when the market is at its peak or at rock bottom. That's because in the short term, market prices are controlled by the collective emotions of investors. Does that sound like something that you can predict? Consider what happened in the Sensex between 2003 and January 2007. The Sensex, I think, went from 3,000 to about 14,000. And again, the run wasn't perfectly smooth. But it was almost 5 years of the stock market going up. So at Jan 2007, what would you think? Is the market at the top? It makes sense to think so, right? The stock market has gone up for 5 years in a row. It's multiplied 4 times. Surely it must be the top. Let's say you believed it was the market top in early 2007 and you decided to sell out of the stock market. Was this a good idea? Well, by December 2007, the Sensex reached a new high of 21,000. If you sold in early 2007, you missed out on significant gains and you probably would not be able to get back into the market. At this point, it would be logical to assume that the stock market must be at a top now. The market has gone up for so long. Surely we sold out a little bit early before, but the crash must be right around the corner. Now the same pattern repeated during the COVID-19 crash of 2020, right? The Sensex fell from 41,000 to 25,000 levels, but then recovered to reach new highs of 47,000 plus by the end of the year. And imagine if you said, okay, this was the top and you exited the market. Today we are at 80,000 plus. Ask yourself, how would you be feeling if you exited the stock market completely in 2007 or in that early or late 2020? Keep in mind that even after the 2008 crash, the market eventually recovered and went up much, much higher. You would probably be kicking yourself. If you just left the money alone and didn't try to time the market, your returns would be much higher. But let's assume that you got lucky and nailed the timing perfectly a couple of times. Right? You sold everything at the exact top of the market. That brings us to another question. How do you know when it's safe to get back in? Is it after the market drops 10%? Or after 15%? Or after 20%? 30%? 50%? Let's say that you tell yourself that you will get back in after the market falls 30%. But what happens if the market falls only 28% and then completely recovers? What do you do now? Do you wait for it to fall again? This brings up the real problem with trying to time the market. You have to be right not once, but twice. You have to be able to sell before the big decline and buy back in before the market recovers. Does that sound like something you can do in real time? I don't think I can do that, right? When you're looking backwards at the history of the stock market, timing the market seems incredibly easy. When you're trying to do it in real time, it's incredibly difficult. The good news is that there's no need to time the market. If you invest on a regular schedule and hold for the long term, the odds are very high in your favor to do really well for yourself. So another very common question I get is, should I buy penny stocks? So when I first started investing, even I was drawn to penny stocks, right? At the time, I had only a few thousand rupees to invest. And when you have very little money, it always seems it's better to buy a few hundred shares of stocks that are trading below 20 rupees than just buying one or two shares of a stock that trades for 1,000 rupees, right? So you use a simple stock screener, find stocks that trade below 20, and then you try and invest in them. In one of these searches for these stocks, I discovered Jet Airways when it had fallen a lot. It was trading at about 15 rupees per share. And since I knew I had flown Jet Airways, I knew the airline, and the share price was low, I figured this was a good investment. Just a few days later, Jet stock dropped to 10 rupees. I immediately became filled with fear, so I sold. I'd love to tell you that this was a single isolated incident, but it wasn't. I bought several different penny stocks and lost money quickly in most of them. Was I just unlucky? I don't think so. I only later learned that the rupee price of a single share of stock is meaningless. It doesn't matter if you own one share or 1,000. What matters is how much capital you have invested in a company and whether that company is worth owning in the first place. I also learned that good companies don't want their stock price to trade at low rupee values. Low stock prices signal to investors that there is something wrong with the business. A low share price could mean that the company is not profitable, is running low on cash, has poor business prospects, is being crushed by a competitor, or is facing a number of problems. As a general rule, if a stock is trading below 20, there's a good chance there's something wrong with the business. Check the market capitalization to confirm the size of the business. You're better off avoiding it and looking elsewhere. So the next question I want to take up is, should I buy stocks with the highest dividend that I can find? This is an interesting question because when I first learned about the dividend yield, I had become very excited. I did some quick research and found some stocks that offered dividend yields of 8%, 10%, or even 15%. Remember we spoke about dividend yield? It's the financial ratio that estimates the cash return an investor can expect to earn from owning a stock or fund. It's always expressed as a percentage and is calculated by dividing a stock or fund's payment per share by its current price, right? So going back to the story, I said to myself, I should just buy the highest dividend yielding stocks that I can find. That way I'll earn a great return even if the stock price doesn't go up. And that's exactly what I did. And like many of my initial instincts with investing, this strategy ended up losing money. What I didn't realize at the time was that dividends are not guaranteed. Since they are paid with cash, only strong companies can afford to make their dividend payments. When a company has a very high dividend yield, say over 5%, it is often because other investors are worried that the company can no longer afford to make its dividend payments it has in the past, and that worry causes the share price to fall, which in turn causes the dividend yield to rise. Remember, the dividend yield is calculated by dividing the dividend payment by the current share price. So if the share price falls, then the dividend yield goes up, right? So I didn't know this was when I was a new investor. I thought that buying stocks with the highest yield was a safe strategy, but in reality it turned out to be very, very risky. The companies that I bought were in bad financial shape, and many of them could not afford their dividend payments. As a result, many of them decided to stop paying their dividends. So after I purchased the shares, not only did I not get a dividend, I had to even sell the shares at a much lower price than I'd bought it. Talk about a double whammy, right? So, so if you're thinking I should just buy the highest dividend yields that I can find, I urge you to think again. Remember, dividends are not guaranteed. So, the next question again is about dividends. Do dividends play a role in compounding? Now, this is a very interesting question, right? So, I don't know if you remember, right at the start of this video, we spoke about how the Sensex has compounded at a rate of about 16% annually. And most of that return is driven by growth in the Sensex's earnings. However, a portion of that 16% return is due to dividend reinvestment, right? Investors have two choices when they receive a dividend payment. One, they can take the dividend as cash, and two, they can reinvest the dividend back into the stock or the fund to buy more shares. Many investors choose to reinvest their dividends. And that can be a smart move because dividend reinvestment can boost the stock or the fund's long-term returns. That's because dividends are used to buy more shares of the stock, which increases the number of shares that the investor owns, which increases the size of future dividend payments, and so on. As the dividends are reinvested, the investor's portfolio grows at a faster and faster rate. So how much of the investor's return comes from dividend reinvestment at any given time? That depends on the stock or the fund's dividend yield. So the dividend yield is similar to an interest rate and is always displayed as a percentage, right? So for example, the Nifty 50 at the end of 2023, the dividend yield for it was about 1.5%. This means that if you invested 1 lakh rupees into Nifty 50 stocks, you would expect to receive 1500 in dividend payments over the following year. A 1.5% return might not sound like much, but dividend reinvestment can have a big impact on long-term returns. Remember right at the beginning of this video, we compared stock investing versus real estate or bonds over 35 years? Let me bring up that sheet for you, right? We saw over 35 years that your investment in stocks would give you 1.56 crores if you invested 10,000 every month, right? And I did a calculation to see what if you did not reinvest those dividends, right? So basically I reduced your annual return from 16% to 14.5%, right? You can see the difference. If you reinvested your dividends, you would make 1.56 crores. But if you did not, you would make only 1.07 crores. That's a 33% drop from your previous earnings. Believe it or not, that 1.5% that you're not reinvesting is making such a big difference to your portfolio. I hope this video has given you the confidence to start investing in the stock market. This is the knowledge I wished I had when I first started, back when I knew nothing about investing. Everything I know today about money, personal finance, and investing, I've learned from experienced investors or books and my own experiences. Some lessons were easy to learn, but others were harder. And I often think, what would I teach my younger self about money? In this video, I've shared important investing lessons with you, and now I want to share some additional money lessons that could help you. So the first is save before you invest, right? The foundation of wealth isn't investing, it's saving. So without a good savings habit, you can't build an investment portfolio. So focus first on growing your income and living within your means. Then clear your debts first. right? In India, we often take loans casually, personal loans, credit cards, even wedding loans. But debt can become a huge burden when times get tough. Make clearing your high interest debt your priority before serious investing. Track your money. Whether you use apps, Excel sheets, or a simple diary, track your income, expenses, and investments regularly. You can't improve what you don't measure. Understand compound interest. We learned about the power of compounding, right? Let me share a simple example. If you invest 5,000 rupees monthly in an index fund earning 15% annually, in 30 years you could have nearly 4 crores. That's the magic of compounding. Don't forget that. Investing is for everyone. You don't need to be rich to start investing. Today you can begin with as little as 100 rupees. Don't wait for the perfect time. Many people wait for the right time to invest. Remember, whether it's Sensex at 40,000 or 60,000 or 80,000, time in the market beats timing the market. Keep it simple. You don't need complex strategies. A simple mix of index funds, maybe some blue chip stocks, a couple of ETFs, can build great wealth over time. Even Warren Buffett, he recommends index funds for most investors. Avoid the penny stock trap. Those SME IPOs or those 5 to 10 rupee stocks might look tempting, but they're usually wealth destroyers. Stick to quality companies listed on the NSE and the BSE. There's an old Chinese proverb that says, the best time to plant a tree was 20 years ago. The second best time is now. This is especially true of investing. Whether you're 15 years old, 25, or 45, the best time to start is now. So until now, we've covered some key questions about investing here, but I'm sure you'll have a lot more questions. And I know there's always more to learn, right? So I request you, please do drop your questions in the comments below. Your questions will help shape our future videos and help others learn too. And remember, there are no silly questions when it comes to investing. We are all here to learn and grow together. Until next time, happy investing.